Welcome, Deep Diver. Today, we're navigating some pretty complex territory.
Yeah.
The current state of the Indian stock market. We're going to do a deep dive into S. Naren's warnings for Indian stock investors.
And this is drawing directly from S. Naren, who heads up ICICI Prudential Mutual Fund.
Right. And just to give you a sense of scale, he manages, what, something like ours, 6.5 lakh crore in equity?
That's right. A huge amount.
Yeah.
So his views carry, well, significant weight.
Absolutely.
So our mission today is really to cut through the noise, you know, and pull out the most important bits of knowledge, the practical strategies from what Naren is saying.
To help you become better informed, more strategic about investing in, well, what feels like a pretty perplexing market right now.
Yeah, exactly.
And, to set the stage for the kind of honesty we're aiming for, S. Naren often quotes Charlie Munger. He really admires him.
Oh, yeah, the fishing rod story.
That's the one. Munger told this story. There was this guy who sold fishing rod sets. I asked him, my God, they're purple and green. Do fish really get attracted by these colors?
And the salesman says,
Mister, I don't sell to fish.
ha, classic Munger.
It is. And Munger added, fund managers remind me of that fishing rod salesman. That really sets the tone for the kind of unvarnished look we need to take.
Definitely. It's about looking past the hype.
Okay, so let's unpack this. S. Naren, he's described as extraordinary for his candor, especially warning small investors to be cautious. What's his first big point?
Well, his first major point is quite something. He highlights that Indian stock market investors,
Meaning people like you and me, potentially?
yes, retail investors, institutions buying stocks, are currently the sole risk takers financing the entire economy.
These sole risk takers, how does that work?
He's saying that instead of companies relying heavily on traditional bank loans for funding,
Right, the usual way.
they're increasingly getting capital from investors through things like, IPOs that might be overvalued, QIPs, that's qualified institutional placements, MNCs selling off parts of their businesses, even promoters exiting.
So the stock market itself is funding growth, not the banks.
Pretty much. And Naren's point is, this shifts the fundamental risk. It's not spread across banks anymore. It's concentrated with stock investors.
That sounds precarious. Are there historical parallels, and what are the bigger risks beyond just, individuals losing money?
Well, Naren implies this level of reliance on market investors is highly unusual. The systemic risk is huge.
How so?
If valuations correct sharply, it's not just banks feeling the pain. It could hit millions of investors.
Which could impact spending, confidence, the whole economy.
Exactly. And that leads right into his next big warning, what he calls insane valuations.
Okay, insane valuations. So following on from that unusual capital flow, he's worried about prices.
Very worried. He's sounding the alarm on stocks trading at PE ratios of 50, 60, even higher.
Wow.
And it's all based on this hope, this expectation that earnings growth will just magically appear later.
But what if it doesn't? Is there a historical lesson here?
There is. He points directly back to the lost decade in India.
1994 to 2004.
That's the one. During that time, tons of small and mid-cap companies just vanished. Why? Because the promised growth, the earnings, they never showed up.
And only the big players survived.
Pretty much. Only the large caps really made it through intact. Naren sees that same risk today. People paying huge prices for future earnings that might never materialize.
So even if you hear people saying, oh, everyone's making money, especially maybe private equity selling IPOs,
Right.
Naren's view is Judgment Day may be yet to come. The real test hasn't happened yet.
He is implying that, yes, just because someone cashed out doesn't mean the underlying investment was sound long-term. And this brings us to a really critical point he makes about the hold for the long-term advice.
The classic mantra. What's his take?
He stresses it only works, only, for quality stocks.
That's a really important distinction because everyone just says, hold for the long term. What's the danger if you apply that blindly now?
The danger, especially at these high valuations, is significant capital destruction, even if you hold for years.
So holding a bad stock long term doesn't make it good.
Exactly. He puts it perfectly. With good stocks, time is your friend. With bad stocks, time is your enemy. Holding junk forever just means you lose money forever, potentially.
And he points to mistakes from the 90s bull market, right? Things we shouldn't repeat.
Yes, 3 critical errors he warns against. First, reducing the quality of portfolios, buying lower grade stuff.
Okay.
Second, reducing the liquidity, buying stocks you can't easily sell when you need to.
Got it.
And third, reducing the capitalization,
Right.
meaning loading up on smaller, often riskier small-cap stocks.
And he's highlighting these because India is kind of an outlier right now.
Very much so. He actually says India is the only market where IPOs are still selling.
Really?
Yeah, he notes that private equity investors admit they haven't seen multi-bagger returns elsewhere globally recently. It just shows how hot things have been here. Maybe unsustainably hot.
Okay, this brings up something many investors might not fully grasp. Buying a stock at, say, 25 PE with no earnings growth. Can you break that down simply?
Sure, let's make it simple. Imagine a company earns 1 rupee per share. That's its EPS.
Yeah.
And the stock price is 25 rupees. So price divided by earnings, 25 divided by 1, gives you a PE of 25.
Right.
What that means is you're essentially paying today for 25 years worth of that company's current earnings, all up front.
25 years?
Yeah. And if that company's earnings don't grow year after year, it would literally take 25 years just to get your initial investment back through those earnings.
That's sobering.
It is. And Naren points out many companies aren't showing earnings growth right now, so even a 20 or 25 PE looks stretched to him, let alone the 50 or 60 PE ratios we see.
But hang on, what about the argument that, Indian valuations will stay high because only 6% of households invest in equity and all that SIP money keeps flowing in? Doesn't that keep prices up?
The flows argument.
Yeah.
Naren has a very clear answer to that.
Which is,
He says, and I quote, "Flows alone cannot determine the valuations of an asset class in the long run. All the market gurus in history have said this."
so the constant SIP money might prop things up for a bit?
Maybe, yeah. He concedes it might extend this overvalued phase for maybe another 2 or 3 years.
But not forever.
Not forever. In the long run, he's adamant. Only corporate earnings determine valuations. And the crucial point is broad earnings growth just isn't happening across the board in India right now.
So looking ahead short term, say the next few quarters, what does he think needs to happen for earnings?
He says earnings need 2 things: a pickup in consumption, maybe helped by the festive season,
Okay.
and better credit growth from banks. But as we discussed, credit growth is currently low, so that's a drag.
Okay, so given this quite cautious, maybe even bearish outlook, the big question is, what does S. Naren actually do? What strategies does he suggest?
Well, this is where it gets really practical. His first key strategy is quite direct. Invest in other global markets.
Look outside India.
Exactly. He observes that many global stock markets are actually quite cheaply valued right now, and some are performing better than India.
Interesting.
He thinks they're likely to deliver decent returns over several years simply because they're starting from a lower base. It's pure Charlie Munger. Fish where the fish are.
Go where the opportunities seem better valued. Makes sense. What else?
He also suggests diversifying to gold.
Gold. Why? Is it cheap?
Not necessarily cheap, no, he admits that. But it's about risk diversification. Spreading your bets.
So a safety play.
Kind of. It fits his view that pretty much no asset class in India looks cheap right now, except, he throws in, perhaps office properties.
Okay. Gold for diversification. What about crypto? That's always a hot topic.
Crypto. He has a very clear stance. No interest in crypto.
Really? Why?
He attributes it directly to following Charlie Munger's warnings. He apparently said something like, whatever Munger said comes true with a time lag. He was against crypto, so I've never considered it.
Wow, sticking to his principles there.
Shows real conviction in Munger's long-term view.
Okay, no crypto. What about his approach to investing right now in the short term? It sounds like he's adapted his style.
He has. It's quite tactical at the moment.
Mhm.
He says if they find a stock, even one they think only has maybe a 10% or 20% potential upside.
It's not huge.
No, but in this market, they'll buy it, aim to capture that gain, and then get out.
So more like trading.
A bit, yes. He actually says, volatility is my friend right now.
How does that work?
Well, say his target upside is 20%. If the stock dips by 5%, suddenly his potential upside becomes 25% from that lower point. So dips create opportunities for these shorter-term gains.
Interesting way to play a volatile market. Are there specific sectors he does see some potential in despite the overall caution?
Yes, he does highlight a few specific areas. First, oil and gas stocks.
Like ONGC, BPCL.
Exactly. He feels these are among the very few pockets in India where valuations might still be somewhat reasonable.
Why them specifically?
He sees them partly as defensive, often regulated, critical infrastructure. It offers maybe a bit of a cushion against wider market drops. It's less about huge growth, more about limiting downside risk.
Okay, oil and gas. What else?
Then there's pharma stocks. He calls this a multi-decadal story.
Multi-decadal, why so long-term?
Demographics, basically. Aging populations, both globally and increasingly in India. That means more demand for medicines, for healthcare, consistently over time.
Makes sense. Any caveats?
He does acknowledge that things like international tariffs or regulations can create uncertainty. But the underlying long-term trend, very strong.
Okay. Oil and gas, pharma, what about banking stocks? That's such a core sector.
Right. His view on banks is interesting. He feels their growth is currently a bit restricted.
Because companies are getting money from the stock market instead of loans.
Precisely. As we discussed earlier, less demand for traditional bank credit right now.
But does he see that changing?
Yes. He actually predicts the banking sector will outperform after a stock market correction.
Afterpen. Why then?
Because at that point, good companies, the ones that survive the downturn, will likely need to go back to banks for loans to fund growth or operations. Credit demand picks up again.
So it's a bet on the future recovery for banks.
Exactly. It's a future-oriented play based on a market reset.
Fascinating strategic thinking. And just out of interest, does he practice what he preaches with his own money? How does Naren invest personally?
He does. He is apparently partially invested in his own mutual funds, which makes sense,
And the rest?
and partially in global stocks outside India.
Ah, following his own advice to look globally.
Exactly. He hasn't said the exact split, India versus global, but it's clear he's allocating capital outside India personally, aligning with his professional view.
Okay. So let's bring this all together. What does this mean for you, our deep diver, listening right now?
Well, I think S. Naren's insights are, first and foremost, a really crucial warning sign.
About the high valuations, yes, but also about this investor risk situation in India.
Absolutely. It's not just numbers on a screen. It's about where the money's coming from, who's bearing the risk, and whether it's sustainable. He's really challenging that default optimism you often see in bull markets.
Yeah, he's pushing back hard.
And then there are the actionable strategies. Looking beyond India, diversifying maybe with gold, and that relentless focus on quality.
Not just buying anything and hoping the long term saves you.
Definitely not. He's really questioning that blind faith in just holding on no matter the stock. It loops right back to Munger. Fish where the fish are.
And right now, Naren seems to think the fish might be swimming in more reasonably valued global waters or maybe in specific defensive spots here in India.
Rather than just chasing the hot, potentially overvalued IPOs or the market darlings.
So the final thought we want to leave you with is this.
Yeah.
As you look at your own investments, are you truly fishing where the fish are? Are you seeking out the most rational, well-valued opportunities wherever they might be?
Or are you maybe, without realizing it, just caught up in selling those purple and green fishing rods? Participating in the excitement, maybe overlooking whether the fundamentals really match the hype.
Take a moment. Reflect. Does your portfolio truly reflect the tough lessons from past cycles and the very candid, very current guidance from someone like S. Naren? Food for thought.